Comments made on the following paid commercial program are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time.
Welcome to the Money and Wealth Show. On the program this week, tax tips with David Ingram, money commercials, and our special guest, Michael Levy. Welcome to the Money and Wealth Show. I'm Sterling Fox, and we're on location in White Rock this weekend to welcome back our special guest, broadcaster, financial commentator, Michael Levy. Michael, welcome back.
Thanks, Sterling.
It's good to see you again. You were among our very first guests on the program several months ago. And here we are, halfway through July, just a little after halfway through 2010. So I thought we'd draw on your expertise to take a look at the year so far and perhaps what our expectations should be for the second half of the year. The first half certainly has, as a nation, we have done very well on the growth side, surprisingly so.
Well, I don't know if it's surprisingly doing well or doing, I think, better than expected as far as numbers are concerned, but we felt going in that once we started on recovery, Canada would lead, and Canada, in fact, is leading. And just some recent reports, the IMF projecting growth went from 4.2 to 4.6% growth in the G20, well, actually worldwide, and Canada to be the leader, followed by the US, but again, Canada leading the pack. The Bank of Canada has come along with their economic outlook, and they're saying that there's a lot more confidence by businesses in what's going on in Canada, and that's a really pleasant surprise because everything that's happened before this has been basically government stimulus, but now you see business starting to spend on inventory, starting to spend on an expansion, on equipment, and you need that private sector buy-in. And you've also got the Bank of Canada raising interest rates, which is a huge signal because what they had, what they called, and what I call, were emergency rates. And when you have emergency rates, that means you're in the midst of an emergency. Well, Canada is no longer in the midst of an emergency, and even though we are not sure where we're going in the second half or into the first part of 2011, right now we don't need 1/4 or 1/2% interest rates to stimulate the economy. So I think the Bank of Canada, by raising rates, has given a signal that they're pretty happy of where we're going.
Now the bank is going to have another opportunity to raise rates again in just a very few days. What are your expectations for next Tuesday?
And that was the third item, is the employment numbers.
Okay.
Our employment numbers just surprised everybody to the upside. They were quintuple or 5 times what the consensus amongst analysts and forecasters were. Our job creation, and even here in British Columbia, the fact that our unemployment rate went up. The fact is it was just more people looking for jobs, but the jobs created went up also. So it was a really good number. So I think that on the 20th, when they announce again, on Tuesday, they are going to announce that they're going to raise the interest rates by another 1/4 of 1%. If the employment numbers had been a little flatter or even a little less than what they thought, then we could have thought maybe they were going to skip a beat because of the question of growth worldwide, because of the European debt crisis, because of what's going on in the US. But when you get employment numbers like that in Canada, then in fact you've got to see a raise in interest rates, and I think the Bank of Canada is going to do that.
Is this a pattern you expect to see continue for the balance of 2010, Michael, with the bank using every opportunity at its disposal to increase rates as the year progresses?
You know, that is, I think, Sterling, the $64,000 question, is that we're looking at things today. And today it looks like they're going to have to increase rates, which in fact they will on the 20th as far as I'm concerned. But where are we going is really the huge question. You've got your debt crisis in Europe, and the sovereign debt crisis is significant.
Sure.
You've got your debt in the United States and the deficit they're putting out. You've got China being questionable in growth. They're trying to cut back a little bit. They're worried about inflation. And if Europe, and here's the big circle, if Europe slows down, Europe buys from Asia, and Asia buys their natural resources or raw materials from Canada. So we could see a domino effect. So yes, I expect interest rates to go up in the fall, but the big caveat is, are we going to get the sustained growth once the stimuli have been pulled off? And in fact, stimulus has been pulled off. The United States is not going to stimulate their economy for the time being anymore. Canadian stimulus has run out. Europe maybe a little more, but not to the extent that it was. So are the economies going to prosper with stimulus pulled back? If they are, interest rates will go up.
Sure.
If they're not, we could get another pullback and even a double dip recession.
What do you mean by a double dip recession? Define that for us, please.
Well, we had the one recession, which started in the fall of 2008 and went through basically to March 2009. We thought it was going to keep going, but then the economy started to expand again.
Right.
So we figured March, April, May, June, and then it's going to pull back. July, August, September, October, then it's going to pull back. It didn't. It just kept going. But now we've reached a plateau where the markets have gone ahead, and the question becomes the economy. Is the economy going to meet market expectations? Because stock markets are leading indicators.
Sure. Yep.
Now, if they don't, if the economies don't match up to the expectations of the stock market, and that's where we are. Right now, as we're speaking, second quarter earnings are coming out.
Right.
And we've had some, there are some more to come. Now, are the second quarter earnings going to meet up with the expectations that the stock market has put on the valuations of major corporations that are reporting? If, in fact, it's disappointing, then you're going to have people coming out of the market, consumer confidence is going to wane, and you're going to have a double dip recession, the second leg down.
Okay.
We've had the single dip.
Right.
Now, if we don't meet expectations, we're going to go down again into the fall. That's the big worry, and that's the $64,000 question. Said before, where are we going? And the problem, Sterling, with a question like that is there's no definitive answer out there in the economic statistics or market movement that we're seeing now. You have gold between 1,189 or 90 and 1,260.
Right.
You have your stock market came right back down and met its support. Then it went up again. You have your Canadian dollar is up 5 cents in the last 3 or 4 weeks. It was 93 and change, came up to 98 and change, has pulled back somewhat now. But everything's trading within a range.
Right.
We have no definitive direction like we had from March 2009 to March, April 2010. There was a definitive direction. That's not in the marketplace now.
How far ahead are stock markets in terms of that early indicator? 12 months, 6 months?
6 months usually.
Okay.
It's a 6 month plus leading indicator. But this has been longer because the market started up. But remember where they started from. Okay, everything's relative. You can get 3 or 4% GDP growth year over year, but where did the GDP growth come from? Was it the lower level? Was it the bottom of the ocean? Or was it a good level and it's going higher? So it's not what it did last year to this year because we started way down in the doldrums. It's what it's going to do this year to next year. IMF is saying it's going to be good. The proof of the pudding will be in the eating.
Our special guest this week on the Money and Wealth Show is Michael Levy. Lots more to come. Stay with us.